How much money is your business actually making? Now, if you're just looking at the income statement and you're measuring your financial performance based on the amount of profit you have there, and you're not comparing that to the balance sheet and the amount of invested capital that's required to keep the business running, you may be tricking yourself because you may not understand the true economic reality of your business. Now, this is me when I was starting out. I had no clue how to read financial statements. Sure, I could take the income statement from my accountant and understand, okay, here's the top line, this represents my sales. Then I could go all the way down to the bottom of the report and see, okay, this is how much profit I'm earning. But when it came to the balance sheet, yeah, forget about it. I had no clue how to read it, what it meant, and more importantly, I had no idea what the story was behind the numbers. And therefore, guess what I did? I just put my head down, and I believed that sheer work ethic and grit would get me through and make me successful. And guess what? Sure, I had some success along the way, but I also made a ton of avoidable mistakes and left a lot of money on the table. And I don't want that to happen to you. So I want to talk about two main things you should be evaluating in your business. All right, so number one, let's talk about net operating profit after tax, also known as NOPAT. Now, there's some nuances here when it comes to NOPAT, and I'm going to talk about those here in just a minute. But the reason why I look at operating profit is because I want to strip out all items that are non-core to the business. So for example, interest income, well, unless you're a bank, strip that out. Interest expense, strip that out, because those items are not core to the operations of the business. They're financing activities. All right, so we'll get into that a little bit later. Also, let's just say I sell a piece of equipment and I have a gain or a loss on a piece of equipment. Well, I don't want to include those gains or losses. Or think about with COVID. A lot of companies took on PPP money and they got government money. You don't want to include those amounts in your normal operating profits. All right, so you want to exclude all that stuff. You just want to look at the revenue that you're generating from core operations, deduct out cost of goods sold, account for operating expenses to arrive at operating profit. All right, now when I say net operating profit after tax or NOPAT, here are the nuances. All right, so LLCs and S corporations, they don't pay taxes. They don't pay corporate taxes, that is. Sure, they may have to pay sales tax and they may have to match employee payroll taxes and there may be property taxes and so on and so forth. But when it comes to income tax, like a C corporation, LLCs and S corps are treated as disregarded entities, and therefore all the earnings or the profits of the business, they flow on to the tax returns of the owners of the company, right? Through a K-1 in the United States at least. So these entities, they don't pay taxes. The owners of the business, the stakeholders, the shareholders, they're the ones who pay the taxes. But ultimately, somebody has to pay taxes. Now, some businesses may be structured in a way where the owners or the stakeholders have to pay personal taxes, and there are no distributions or dividends made to cover those taxes. But for a lot of businesses, the reality is at the end of the year, let's say there's a tax bill of $100,000. Well, the owner of the company is probably going to take a distribution. They're going to take cash out of the business in order to cover that tax bill. So what I'm saying here is at the end of the day, somebody is going to pay taxes, even if the entity is a disregarded entity. Now, when I was in school, all right, I remember doing case study after case study after case study, and guess what? They're all for C corporations, and C corporations, they do pay income taxes. But then when I got into the real world, and I've spent my career turning around and growing companies, I realized, look, these case studies, they're not relevant. So should I include taxes or should I not include taxes? And here's the reality. I think you should account for taxes when you're computing this very important ratio that I'm going to talk to you about here in just a little bit, which is return on invested capital. Now, with NOPAT is going to be the numerator, all right, in the formula. I'll get to that here in just a minute, but you have to account for taxes. So you could take your operating profit, right, in your business, and then just apply an effective tax rate. So maybe you're like, okay, I'm going to apply a 30% tax rate or a 35% tax rate, whatever it may be. You can estimate it, number one, or you could go to your tax return and see how much are you paying effectively in taxes and then use that percentage in your business. Nonetheless, when I'm building financial models, oftentimes if there are multiple stakeholders in the company, right, everybody's going to have different tax rates. So therefore, I may just use a tax rate of 35% to account for the blended rate that is being paid by all these individual investors and to account for the taxes that ultimately have to be paid. All right, so that's what you do. We're excluding all non-operating, non-core items from profitability, and then we're applying some type of tax rate to come up with net operating profit after tax. That's NOPAT. All right, that's great. Now, what we need to do is we need to move on to invested capital, because this is going to be our denominator. This is going to be the bottom part of the equation, all right, when it comes to return on invested capital. So let's talk about invested capital and what it is. There are really two component parts. Number one, there's working capital, and number two, there's net property, plant, and equipment. So let me explain each of these. The first component, working capital, is the difference between current assets and current liabilities. Now there's a caveat here because we want to exclude excess cash. So in other words, if your business is sitting on just a ton of cash, you keep stockpiling cash because you're earning all these profits, but you're not distributing those earnings, then your cash is going to continue to stockpile theoretically, right? Now, you may be wondering, what is excess cash? I would say in a company, if you look at the operating expenses, okay, the monthly operating expenses, you may say, look, we want to hold cash equivalent to 3 months of our OPEX, our operating expenses. Let's say, to put numbers to it, you have $200,000 in operating expenses in your business. You just multiply that by 3, and therefore that would give you $200,000 a month in OPEX times 3 months as just some type of factor, $600,000 in operating cash. And then anything above that would be considered excess cash. That's one way to do it. Now, there's no hard, fast rule here. You may believe that your operating cash balance should only be 2 months of OPEX, or you might be more conservative and you may want 9 months of OPEX. Whatever you choose, just be consistent, and you may want to compare what is standard out there in your industry. But let's just go with 3 months, all right, of operating expenses. Take your OPEX, multiply it by 3 months. There's your average operating cash requirement. Anything above and beyond that, as it relates to your cash, you're going to exclude that from current assets, all right? But current assets are going to include your operating cash, your inventory, your accounts receivable, the amount of money that you're owed from your customers, prepaids, and other items that are collectible within a 12-month time frame. Hence the word current. Current is 12 months. Now, when it comes to current liabilities, you're going to take accounts payable, accrued expenses, payroll liabilities, all these current liabilities that are due and payable within 12 months, and you're going to exclude any interest-bearing debt. Now, here are some nuances. Let's say you use a credit card. Sure, you pay interest on a credit card, but if you're just charging up the credit card, but you're paying it off every month, you wouldn't exclude that from the working capital calculation. But let's say you're using a credit card and you're charging things on your credit card and you're accumulating debt and you're paying interest on it, then you're going to exclude that amount, that balance from current liabilities. All right, now when it comes to trade vendors, since these accounts are related to the normal operations of your business, they're going to be included in your working capital calculation. So you take current assets, exclude excess cash, current liabilities, exclude interest-bearing debt balances, all right, and then do the math, and you'll end up with your working capital balance. All right, this is the amount of working capital that's required in your company to keep things going. Then the other part of the equation is net property, plant, and equipment. So just think about property, plant, and equipment as all the equipment, the machinery, your tractors, your vehicles, your building, everything that's required to run your business. Now remember, when you go out and buy something, like a truck, for example, you can't just expense that on your income statement. Instead, you have to capitalize it and record it as an asset on your balance sheet, and then you're going to depreciate it year after year after year until it has a zero value. So that accumulated depreciation is what makes up the term net. So when I say property, plant, and equipment, You're accounting for all your vehicles, your machinery, your building, all these assets, and then you are subtracting your accumulated depreciation over time, and you'll arrive at this net property, plant, and equipment balance. And what that number theoretically shows is some type of current value of your assets. Now, there are some nuances there. For example, you use Section 179 to depreciate your assets in the first year. All right, that may skew the calculation here. But essentially, what you want to do is you want to come up with some number or some value of your property, plant, equipment, account for depreciation, and there you have it, net PP&E. All right, so when it comes to invested capital, you are combining your working capital, which I just walked you through, and your net property, plant, equipment, which we just talked about, and that will give you your invested capital base. Now, this is why it's so important. Let me ask you this. Let's say you have two companies. They both make $1 million in revenue. One has a 10% net operating profit after tax margin, right? The profit margin. The other company has a 7% NOPAT margin as a percentage of revenue. Okay, so one's 10%, one's 7%. They both have the same amount of revenue, $1 million. In other words, which one is more financially successful? Now, you may be tempted to just say the one that's earning 10% because a higher profit margin indicates financial success, right? Well, that's what I thought back in the day. And trust me, if you are not accounting for your invested capital, you're definitely going to be skewed. So let me explain. Let's take company A that's generating $1 million in revenue and is earning a 10% profit margin, right? Net operating profit after tax, that is. When I say profit, just think of NOPAT. So they're earning 10% on that money. So they're making $100,000. You may say, wow, that's great. Compared to company B, they're making $1 million in revenue, but they're only earning a 7% margin on that money. So they're not performing as well, right? Well, let's look at the capital base of company A. What if it took $10 million in investments? So people had to invest in property, plant, and equipment, and there's all this working capital required to shore up the business and to provide the company the liquidity that it needs to operate. Say the invested capital is $10 million. Well, $100,000 divided by $10 million to get there, to get that $100,000, is 1% return on invested capital. And that's the equation. Return on invested capital is your net operating profit after tax divided by your invested capital, which is made up of your working capital and net PP&E. So company A is actually only earning a 1% return on invested capital. Compare that to company B. Okay, 7% margin, right? So $70,000 on $1 million. And let's say the owners of this business only had to put in $1 million to buy vehicles and equipment to make the business run. And they have just a little bit of money tied up in working capital. Well, $70,000 in profit divided by $1 million in invested capital is 7%. So does that change your answer? Because profit is not just profit. And this is where leaders can really go astray. Now you may be wondering, Steve, what's the big deal? It's just profit. Yes, company A is still earning higher profits. Well, sure, but you're pouring a ton of money into that business, and that money, guess what, is stuck on the balance sheet. And you're not getting it out as a business owner until there's some type of liquidity event in the future. So your money's tied up and it's only earning a 1% return. Now you can get a 1% return very easily by going to your local bank and just putting your money in a money market account if you want low returns like that. And compare that to company B that's earning a 7% return. That's a big difference. Now we have to factor in one other thing, and that is your weighted average cost of capital. I'm not going to get into the details of calculating weighted average cost of capital, but let's just say for this scenario that we're talking about with company A and company B, the weighted average cost of capital is 9%. All right, now let's evaluate these two companies. The one that's earning 1% returns on invested capital has a cost of capital of 9%. So guess what? They borrow money from debt providers and equity providers, but they only earn 1%. Right? That's terrible because their cost of that capital is 9%. They're earning 1%. They're losing effectively 8% every single year on their capital. Also, let's look at company B. We may say, look, 7% is great. It's way better than 1%. But what if their cost of capital is 9%? They're actually still losing value. So that's why it's important to compare all these things, net operating profit after tax and invested capital, to come up with return on invested capital, and then compare that to the weighted average cost of capital of the firm to determine whether or not true value is being created. Now, what is a healthy return on invested capital, you may wonder? For high-tech companies, take for example Google, it's around 30%. If you look at the construction industry, return on invested capital is around 12%. If you look at the pharmaceutical space, it's around 13%. And if you compare that to just the overall market, excluding financial firms, it's about 14.7%. Also, you can look at the overall stock market, which over the last 50 years has returned on average between 9 and 10%, let's say. So if your business is earning a return on invested capital of 5%, you may want to take a second look at your operating model, your strategy, your performance, everything else, because the stock market, which represents all the public equity, is earning a significantly higher return than the 5% you may be earning. So that's how I like to look at businesses and their financial performance, not just at the income statement in isolation or the balance sheet in isolation. You have to compare the two and you have to marry them together. And when you marry the income statement and the balance sheet together, that's when you get the statement of cash flows, which is my favorite financial statement because it tells you how much cash a company is generating. And remember, firm value is determined by the intrinsic value of the company, which is the present value of all the future cash that the company is going to generate over its remaining useful life. See how this all comes together? You may be thinking, oh my gosh, Steve, you are such a nerd with all these numbers. But look, this stuff is really, really important because the last thing you want to do is to be trucking along year after year in your business and you may realize, like, look, I'm not even generating returns that are sufficient to cover my cost of capital. Sure, you may have profit, but your returns may be super low, especially compared to your risk. Now, what do you do if your business is struggling? There are a lot of things you can do. First, you can put in place a strategy which will help you to provide clarity and direction to your team. Okay, and outlining your initiatives to overcome your strategic problem and everything else is super critical. You can also evaluate the drivers of your business. Break down return on invested capital and its component parts and build out a logic tree, and then you'll be able to pinpoint certain areas in your business where you can focus in order to improve performance. That's what I do. That's what I do for a living. I go into companies and I turn them around, and that's what I do. First is I put in place a strategy, and then I look at the value drivers and determine how can we improve these value drivers in order to maximize firm value. But this is a really important topic that I wanted to get out there because if you are ignoring invested capital, you may be making decisions off your income statement that are actually hurting your business in the long run. All right, so that's all I have for you in today's episode. Be sure to do this evaluation in your business. And as always, if you ever need help, please feel free to reach out because I love this stuff and I'm happy to have a conversation with you. All right, until next time, take care of yourself. Cheers.